And good evening, everybody. How are you doing? Welcome to Sunday Night Live, Moffat on Money. I'm Clay with the awesome E-Train,
I don't know about that. Lord have
who
mercy.
has been playing nurse to Mahoney, little cat. Mahoney had just had a seizure as we were about to begin the show. So that was the reason for the delay.
I apologize. That was it was a grand mal. It was a big one.
Yeah, she is, however, doing okay. She's at Ellen's feet, apparently eating and purring.
She is purring for sure.
So she is doing okay. We
Yep, she's right
obviously
at my feet.
obviously had to make sure she was okay before we popped on. So,
I mean, you
but she
guys
is
are
okay.
important, but my kitty cat, I do love her. So she kind of comes first.
And she is a sweetie. She really is. She
Hmm.
is a sweet, gentle natured killer.
She is a killer. Yeah, she hunts.
She she
Great
does
hunter.
hunt like crazy, but she otherwise
And
is just gentle as hell.
and that's one of the things that I wonder about because she started having these, a couple years ago?
Yeah.
And but we're in a neighborhood where everybody like poisons everything. So I want, okay, don't knock the trash can over. Now she's like being a nut job. Um, come here. I wonder if like somebody poisoned a mouse or a rat or a bird or something and she ate it and that is what has caused this. I don't know.
Don't know.
But yes, she's purring. Purr for
I
everybody.
can
Yeah.
I can actually hear her a little bit.
Mm-hmm.
She has a loud purr.
Yes, she does. Got a loud motor, don't you, little girl?
But she's a sweet cat. She is. Um Sunday night been a good week. Starting to get some rain around here, some heavy thunderstorms. So we have been in dire need.
Yeah.
We were getting a little dry actually. Been a long time without some rain. So the whole South is picking up rain.
Let me tell you, you're about to get 3 days of it. Actually, four, because it's supposed to rain all day here tomorrow as well.
Yeah, I think it's moving up north. So
Is it?
if you
So it's kind of going in a
yeah,
weird direction.
yeah. Usually it kind of moves northeast, but this, I was looking at the radar before it came on. It looks like it's moving almost directly north. So
Yeah, I
um,
gave Clay a warning. I was like, my interwebs might not be awesome because we've had thunderstorms for the past several days.
yeah. But we needed the rain. It is good to see the rain. I am not going to complain. So I'd like to welcome everybody to Moffat on Money. If you're watching, say hey. For those of you on the replay crew, leave us a note. Let us know you're doing well. We appreciate the members of the family that watch, support the channel.
And for all of
This
you
is a
moms or for baby moms, happy Mother's Day.
happy Mother's Day to everybody.
Hmm.
We I was going to start off saying we're going to cover a topic that everybody in the markets is talking about, and it is May the 11th, 2025, and was originally thinking, no, it's not Mother's Day, but we do wish all the great moms out there a most joyous Mother's Day. And
And for
also,
all you
I will
dads who are moms.
I will throw out a shout out to the single dads who are moms.
Hmm.
And on Father's Day, I will do the reciprocal. But that is a segment that oftentimes is underappreciated. Single parents that have to carry both loads,
It
and
is.
that is not an easy job.
No, it's not.
And for those of you that have been celebrating Mother's Day, what a better way to finish off the day than to spend it with Moffat on Money, learning about the incredible world around you. So we are glad to have you. Now, for those who are interested in the markets, in the economy, how the economy is doing overall, you may have been feeling a little unsettled lately. A lot of people have. Don't worry. Um, the the economic tea leaves, if you try to look at everything going on, are messy. We've got slowing growth in some sectors, jittery markets, extremely jittery markets, softening job numbers, and an absolute political circus with a global audience. So, for those of
Yeah,
you who are,
go ahead. I'm sorry.
no, what'd you say?
I apologize if I'm wiping my face a lot. I've got a ton of cat hair all over me. So
I think
it's
that's
an it's
I think that's probably Macron's excuse too.
ha 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 ha. No, it just
Macron and hunters and the whole
everyone's
gig.
No, mine's actual feline hair. If you are on right now, and we love it, we appreciate seeing you. Thank you for being here. And if you don't mind, hit that like, subscribe. It costs you nothing, but it
does
helps us
help
a
us
lot.
out. Yeah, it really does. When we do appreciate it. Hello, Jane. How the hell are you? The joys of being a pet parent. Yeah, and that is the toughest part. That and losing them.
Yeah, it is. It's like I was like, Clay, hang on, Honey's having a seizure. We're gonna be a little bit late. I actually had my roommate text Clay. I was like, I threw my phone at him. I was like, text him, call him. I don't care what you do. Just let him know that I'm in the middle of something right now.
Yeah. Well, we are all glad she's okay. We all love Mahoney. She is a very lovable cat. Some cats are really aloof, independent. Mahoney will, she'll hang around you. She'll, want some attention every now and then. She's a sweet girl.
She's a little snuggler.
Yes, she is. Now, tonight's topics really is, are we headed into a recession? Or is this just another bout of economic hypochondria? The internet. Go ahead.
Can I give my quick opinion?
Yeah.
I don't know how we could not go into a recession. That's just and I don't know. I don't have the brain that you do or the mind that you do, and I don't do all the research that you do. But with in the past 6 years, it's like, how could we not go into a recession? I guess it's COVID.
Well, I will go ahead and say you have a very good mind. You're very bright. You don't have the love and passion for data and economic statistics that I do, and I would say that probably is true of most everybody in the viewing audience.
Yes.
There's a whole hell of a lot of intelligent people that just don't care for that gig. Everybody has their gifts. Now, I have argued that the private sector has been in recession for a year. They've been losing full-time jobs roughly, and I forget the exact calendar probably, but it's 2 million jobs have been lost over the past year and a half. That's a lot of jobs.
Okay, now wait. The definition of a recession is, oh God, 3% GDP or no, over whatever it is, over 3/4. We had that.
No, that's kind of a. Some people will say it's negative GDP for successive quarters, two quarters, but that is not the real definition.
Okay.
The government branch that is the official arbiter of when a recession starts and begins is the NBER, and they describe it as a significant economic slowdown identified by, and then they list a lot of variables. A decline in GDP is one. They don't necessarily specified as 2 negative quarters, but a lot of shadow economists will kind of use that because
Okay.
it is not altogether uncommon, but that is not the technical definition. And, if you looked at the private sector over the past year and a half, 2 years, you probably would have negative growth for at least 2 quarters along in there.
And when you say private sector, what are you referring to?
Privately owned companies, non-government.
Okay. Anything not government owned, not like we're not talking
Yes.
like Walmart, or we are talking about like Walmart,
Yeah, it would be Walmart.
big box
Walmart's not owned by the
stores,
government. Yeah.
Yeah, I
Yeah.
just meant, are we talking about encompassing, or are we talking about just small business?
Yeah.
That's what I
No,
just want to
all
get clear.
privately owned business.
Gotcha.
The thing is, the GDP calculation includes government activity, government spending, which the government has gotten so large, it's a significant portion of GDP, and that portion kind of varies. Like healthcare, most people would think healthcare is a private sector, but who actually ends up paying for most of healthcare?
The government.
The government via Medicare, Medicaid, VA, et cetera, et cetera. Also, education.
Mm-hmm.
The government expenditures on education and hiring new teachers is included. So if you take out the effects of government, people talk about, oh, GDP has been 2-3% for every quarter for the last several quarters. You take that out, and we likely would have a negative GDP repeatedly. And so, we can look at the negative GDP, that we just had. Government spending was down 5% in one
Okay,
quarter.
I'm gonna interrupt you. Are there slides for this?
Yes, we
Okay.
just
I
got
just
off
didn't
on
want you
another
to
topic.
forget to put them up there. Okay.
Yeah. So, we talked about the last couple of weeks about the negative GDP, how it was due solely to imports. Imports of goods, which jumped sharply when Trump first mentioned the word tariffs. A lot of people tried to beat the rush and, import as much as they could to avoid the tariffs. So there was a huge surge in imports, and 50% of the imports were gold imports. So importing gold. Remember, we talked several weeks ago about gold futures and how there wasn't enough gold in the US, and we had to import gold from Switzerland and London to to fulfill the futures contracts because gold futures had just exploded. Well, that gold imported lowered GDP. And you'll have a hard time convincing me that that actually hurt the economy.
But have Elon and Trump gone to Fort Knox? Is the
No,
gold there? Are they just replacing that gold? Just asking.
it's not gold reserves, it's the gold market reserves. COMEX,
So it's
Commodities
not
Exchange.
bars of gold.
It's not government, it's not the government reserves.
Okay.
So I can go I can call up my broker and I can say, I want to buy a gold futures contract. Right now, gold is $3,300 an ounce and change. So let's just say 3,300. I think it's going to go up. So I buy a 3-month contract, which allows me to buy gold at $3,400. I don't actually have to pay anything, but I just commit to this futures contract. So in the future, 3 months from now, I get to buy gold at $3,400, Well, if gold goes up to 35, 3,600, I'm going to buy that gold. I only paid 3,400 for it. But whoever sold me that contract has to deliver it in gold. So they were having a hard time getting enough gold to deliver to the people who were buying the contracts, and gold price was, shooting up. So they had to transfer and import some gold from other vaults around the world.
Okay, can you explain that process again? The futures contracts, buying
Sure.
something in advance of when you actually purchase it.
It's a deal where you agree to uh, buy something in the future, sometime in the future, at a price agreed upon today. So, like, it was actually futures contracts were actually started by farmers, because if you think about it, if wheat is harvested in the late summer, early fall, when's the best time to sell wheat?
Late fall. No,
Now
wait,
that's
wait,
when,
no, wait. Spring, when you plant it.
yes,
Okay.
yes, when it's out of season and when it's furthest from being harvested. That's usually when the prices are highest. And so farmers were sitting there thinking, I wish I could sell it at this price instead of having to wait till the fall to sell it. And when everybody's harvesting and prices might be very low. That's how futures contracts got started. Farmers started agreeing to sell a portion of their crop in the spring or winter. You could do 10, 20% of your crop, because you knew even in a bad year you'd have that much. You'll have to
Mhm.
deliver that wheat. So if you don't grow
Right.
it, you have to go out and buy it. But you sell 10 or 20% of your crop, whatever it is that you think you can get even in a bad harvest, and you lock in that higher price. So come the fall, you may have a small harvest, but an amount equivalent to that 20% of your normal harvest is going to be sold at that higher price, regardless of what the market price is. The market price could be even higher. Too bad. You're only selling it for that futures price. But if the market is lower, if there's a big wheat harvest, prices drop. And the farmer has locked in that higher price. So it's a risk management technique.
Okay. So with gold, though, I assume these people bought these futures when the gold price was much lower.
And at any time when they think it's going to go higher, or you can take the other side and you think the price is going to go lower, so you can sell it in the future.
Okay. See, now you're don't confuse the one. Just let's get this point.
Yeah, it's the same coin, just the other side. Somebody's a buyer, somebody's a seller. Well, they have different views on the direction of the price of gold.
But like somebody wouldn't buy it a future when it's 3,200 and going up for 34.
Yeah, I'd buy it all day long. I can buy it at 32 when it's 34.
No, but if it's rising that quickly, right? You're not going to say it's 30 future and for 34, right? Does that make
You
sense?
broke up on me a little bit. Try it one more time.
Okay, so the price of gold is 30. Okay. You're not going to put a future for if you can get it for 32.
You're still breaking up on me. Sorry. Um,
I'm sorry. Never mind.
basically, let me just try this. Today gold is selling for 33. I think the price of gold over the next 3 months is going up. So I enter in a futures contract to buy it in September at $3,400. Well, September comes and gold prices continue to increase. It's now $3,600. You with me?
Yeah, but why wouldn't you just buy it at the price it is now instead of, because that's cheaper?
No, my futures contract is cheaper. I can pay $3,400 for it when it's $3,600
But why not buy it at 32 when it's 32?
because I have to spend $3,200. It goes up to 3,600. I only make $400, but my money's tied up.
So you're
Okay.
not actually putting that money up for it.
No, you don't have to put any money up for it.
Okay. That's why you don't go ahead and buy it.
Yes.
Explain that.
Well, I have zero invested, and come September, I make $200 an ounce from 34. The difference between 3,400 I pay for it versus the 3,600 it's actually selling for, which I can obviously turn around and sell it immediately. So I gain $200 an ounce, and I have zero invested.
Okay. Now
If I
that makes
buy it,
sense.
yeah.
Gotcha.
So the it magnifies the returns.
That makes sense
Now it can
because you're
also
not
magnify the losses.
true.
But if I am a farmer, I have the wheat. Now you can't say this about gold, but if I'm a farmer, I have the wheat. So I have
Hmm.
risk being the wheat owner that the price is going to fall by the time I can sell it. So if I can sell it today at that higher price, even though I won't be able to deliver it for months, I can lock in a price which guarantees me a profit, guarantees that I can stay in business for another year, even with a bad harvest. So it's a risk management strategy also.
It's that part wasn't clear. When you say you're buying,
Okay.
it sounded
It's
like you're
it's
putting money into it.
yeah, it's spring. I'm planting wheat,
Right.
and the price for wheat per bushel is $6 a bushel. Well, let's say in fall, when all the wheat is harvested, the price is at its lowest. Normally, I'm thinking it's going to be at $4 a bushel. So I want to lock in that $6 a bushel for 20% of my expected harvest. So I sell a futures contract for that amount, however many bushels that would be. Well, come the fall, when I actually harvest the wheat, I have to honor that contract. So I have to sell that wheat for $6 per bushel, regardless of what the market price is for the rest of my wheat.
I know I'm beating the hell out of this point like a dead horse
No, that's all right.
because I'm trying to make sure that I and everybody else understands. And Jane, I know you do. Hush, I want to hear about you. But but from the buyer's perspective, right?
Right.
He
Why?
could buy, huh? He could
Why
buy the
does a
wheat.
buyer buy it at the high price?
Hang on. He buys the wheat at $6 a bushel or whatever it is, right? The farmer ends up the price is $8 a bushel. So the guy who made that agreement with the farmer can actually sell it to somebody else for $10 a bushel and reap in the
Yes.
extra cash.
Yes.
That's what I was trying to. Okay, now I got it. I got you.
And but a lot of the buyers in the spring are like bakeries who
Hmm.
want to ensure they have a minimal quantity of flour to make their products,
Hmm.
because if there's a bad harvest, not only is the price going to go higher, but the availability is going to be more limited. So
Supply and
it's a
demand.
risk management strategy on both sides.
Got it.
That makes sense?
Yes, I was just trying to figure out why someone would buy it at a lower price, but when you explain them not actually putting money into it, be able to sell it immediately, that I get it now. Yeah,
Okay.
we're rambling. Sorry about that.
No, that's you know, it's important that people understand the terms. Otherwise, this is all for naught. And that's why we encourage questions from y'all. If I say something that doesn't make sense, because sometimes I'm just talking off the top of my head, not really. Um, I'm focusing more on what I'm trying to say, and sometimes I might throw out a term or use some idea that's not intuitive or native. Don't hesitate to ask. We welcome questions and comments.
Yeah, just
This
like
is
me.
pretty much an open forum.
Yeah, I'm not afraid to and I will beat it to death with Clay. He knows that until I understand what he's talking about. I'm like, no, but I hear what you're saying, but I need to understand exactly the point you're making. And
And that's a good thing.
yeah, so I mean, seriously, ask all the questions you want. We have no issue with that. There is no stupid question.
Yeah, and Ellen is monitoring X and Rumble as
Mhm.
well as YouTube to make sure that the questions do come through. So
Yes, I am.
feel free to throw them out. All right,
That's the other part of my job besides drilling down Clay on a point.
taking care of seizing cats.
Hey, it's Mother's Day. Why not? I had to have one child
All
was an
right, so
issue.
so let's grab your coffee or a good scotch, settle in, and let's try to unpack what's going on in the economy and the markets, why it matters, and most importantly, how you can protect and grow your wealth. Now, let me do a throwback here a little bit to 2008. Remember, there were many small business owners. And it could be a little bakery, since we've been talking about bakeries. Could be a little bakery. They were doing great, had cupcakes flying out off the shelves left and right. Bakeries are common today. I saw a picture of Keanu Reeves. Yeah, I don't know if it's necessarily this year, but he apparently lives in New York, just walks around like a homeless guy. And he for his birthday one day, he apparently goes to this bakery and just buys a little cupcake with a candle in it and sits down
Really?
outside and eats it. That's his birthday cake. So
Aw.
that just hit me. Yeah. So
All
we've
right, real
got
quick.
Keanu.
Hang on. Before you move forward, Talia, thank you for being here. We appreciate you asking the question. Clay, take it
Yes.
away.
Thank you. Yeah, sometimes I don't see the question, so Ellen will draw my attention to them. Does it make more sense to move forward with buying a house now or wait to see if the market crashes? We're actually going to talk about that a little later, but for just to give you cliff notes, my impression with what I see going on in the housing market is that prices are falling in many markets. Supply is starting to increase. Now it's not up to a great level, but it is starting to increase. And so in a lot of markets, you probably will be able to buy it cheaper 6 months or a year from now.
Question. I have heard recently from realtors that people are looking for more land and getting out of the urban area. Do you think that that will affect homes that have a greater acreage as much as ones that do not?
Well, I think, and this kind of, I saw Keith's question pop up.
Hmm.
There's an old adage in real estate, three things are the three most important things in real estate.
Location, location, location.
Boom. And so even if houses are decreasing in most of the country, there are certain little small areas where they will be increasing. So it is very location specific. Um, done more home inspections for banks this year already than the past 4 years. It's a good year for you, then I hope.
Yep.
But in a lot of markets, a lot of demographics, there's change. For example, Florida, Texas, California, Michigan, Illinois, a lot of these states have seen a lot of people moving out.
Wait, you said
Florida,
Texas, Florida moving out?
yeah.
Why?
Florida is probably going to experience a population decrease.
Really?
Yeah,
Explain.
the a lot of the people can't get insurance or can't afford the
Oh,
insurance on their homes, and so they're
right.
having to just dump them all out. Vacate people aren't vacationing as much over the past year, so a lot of the Airbnbs that were bought at the high prices, people thought, prices will go up forever, and people will keep vacationing. A lot of those are having to be dumped on the market.
Fair enough.
Even some institutional owners are selling. Commercial real estate has been getting creamed. So holders in commercial real estate are losing big. Sometimes that forces them to sell off other real estate to cover some of the losses.
Well, that's been going on for years since
Yeah,
COVID, right?
yeah, several years. So there's a lot of different factors, but Florida is really getting hammered by the lack of insurance and the number and the hurricanes. Hi, I'm keeping my fingers crossed that the USDA Rural Home Program sticks around through the end of the year. I believe that's likely. Haven't heard, because the administration is generally friendly to trying to increase the number of farmers, which have decreased for years. So we need more people qualifying for, rural agricultural development.
And there's a bunch of those around here. I mean,
Yeah.
USDA.
Yeah. Heard the Carolinas are becoming the new place to move to. Ellen, look at how many large neighborhoods are going up here. Even our interstates are adding more access on ramps.
It's true.
Yeah,
It's
I
crazy.
hope I hope most of that is urban, because I'll be
I
buying
know.
some land here before long, and um, North Carolina is, the North and South Carolina is one area I'm looking at up in the mountains. So we'll see
Yeah.
what happens.
Yeah. Keith, the butterflies, though, 20 and 26 are what a mess. Just saying. That is like a wreck just begging to happen.
Oh, the
Oh,
interstates?
oh yeah. I mean, they did the butterfly thing they did, but
No, I
both of
don't
them are
know,
so
but I do
busy.
now. I thought you were originally talking about like little insects.
No, no, no. The butterfly, the loops.
Yeah,
Oh, what a shit show.
yeah.
Um, it's awful. Now we actually went to Sam's Club today, and driving down the road, malfunction. Yeah, that's what they call them around here, malfunction junction. But went to Sam's and passed by a guy who flipped his Toyota truck. His little girl was there with him. Oh my gosh. Like, totally stopped to help, but everything was okay, except for the truck was upside down. But yes, malfunction junction that is the term down here.
Well, how the hell did he do that?
That is a very good question. One
Huh.
that I was wondering all day long. How do you flip your truck all by yourself going up a hill? No idea. Could
Well,
be.
all right, could
Could be
be. But
texting.
if you're texting with a kid in the car, you need to be beat. Anyway,
Oh, When I left Sam's and drove right back by, Mama was there. They were Spanish speaking individuals, and I don't know what she was saying, but it was very fast and it was not nice. Mama was not happy.
All right. Well, let's continue the dive into what's happening out there in the economy and what you can do. We're going to
Ah,
start off with what everybody loves, data.
yay.
That Chase Mahoney off.
No. I was actually Vince came in here and I was just making sure Mahoney, she's in her poof. She's okay.
Okay.
Just want to make, you know, gotta check her.
That, no problem. Um, so a lot of people are, having increased conversations about, is a recession coming or is recession here? So if we look at, some of the data, and there's tons of data. I'm not going to give you all of it, but I'll give you some of the highlights. CNBC takes a survey of the CFO, Chief Financial Officer Council, from quarter one of 2025, this past quarter, found that 60% of the top corporate executives expect a recession by the second half of this year. That's a big deal. When CFOs get nervous, that's a signal something's brewing. These guys obviously know more about their company and what their company expects over the next few months than anybody else. That's an important bit of info. Now, we saw where quarter one GDP growth came in at just 0.6%. This is for the quarter, not last month's. Last month's was negative, but this is for the quarter. The lowest since late 22, the COVID era, some things like that. Consumer spending has weakened, which we have a consumer-driven economy. When consumers start spending less, that's a good sign a recession is coming. The ISM Manufacturing Index. It's a survey of manufacturers, whether they're increasing manufacturing or decreasing manufacturing. Well, that survey has showed that manufacturers as a whole have been decreasing production for 9 straight months. 20 out of the last 21 months. It's significant. Now, the downturn isn't a new phenomenon. Remember, this recession isn't just about 2 negative quarters of GDP. It is a broad-based economic decline. Jobs, income, production, the whole range. And each one of those foundations of the economy is wobbling. Now, unemployment's even starting to tick up some. Ticked up to 4.3, which is historically low. But if you look at what's behind the headline, job openings have dropped sharply, down 25% from their 2023 peak. I mean, they've been declining consistently. They've been falling in the private sector for a while, but now the government has joined the conversation. Wage growth is holding at 4.3%, which is pretty strong. It's above inflation, which also kind of means it might be adding to inflation. As companies pay their workers more, that's a cost they have to ultimately pass on. Remember, we talked about wage growth last year and how wage growth always follows behind inflation. The increase in inflation after inflation has done its damage. Well, still kind of working on that. Now that inflation is tamping down, or has, you normally would expect to see wages start to flatten. Notice, I said normally. There's a big variable that we haven't had to deal with before. The deportation of, a million immigrants this year, maybe. several million immigrants a year. The big question, and I haven't seen good data, but the big question is how many of these are actually working in a proper job? Or are they largely criminal? Or are they largely just living off the largesse of the US government?
Or under the table, or
Under the
all the
table, yep.
things. Yeah.
And keep in mind, most of them send a bulk of their money back home, so it doesn't even get spent in the country. Don't have good data. So I honestly don't have a good sense of how that will impact wages or on the supply of labor. The data is murky at best, and there's no evidence yet showing a sharp or showing a shift, any kind of shift in job markets, labor markets. That kind of implies to me that those being deported were not employed.
Yeah.
So, keep in mind the current administration also administers and is encouraging a program called the H-2A visa.
Well, it's been in effect for quite a few years, right?
Yeah, but they're pushing it now. And this is
Okay.
a temporary migrant visa that allows workers from abroad to come in for seasonal farm work when there aren't enough domestic workers available.
I was going to say
You want
something.
to
I
say
forgot what
something?
it was. I forgot. Clay, you know me. Like, if I don't stay on the
You'll
thought
think
of
of it in a minute.
consciousness, it's. I was
Now,
thinking about. Never mind. Go ahead.
well, while you think about it, I'll go ahead and throw some other
Please
stuff
do.
out.
Please do.
Now, we're starting to see layoffs in white collar sectors. I mean, obviously government, but also for the past 9 months or year, we're starting to see some significant layoffs in tech and finance. Both of those are climbing. Uh, had a friends in fintech industry. I won't mention the company, but tell me their firm decided to cut 12% of the staff last week. Not because of losses, but because everybody else is tightening up. So we don't want to be the last. That's kind of classic pre-recession behavior.
Quickly.
Now, okay.
I don't know if you saw this or not. I was watching the Senate was interviewing Kash Patel about his it was the appropriations committee for the Senate, and they were they said this is the request we got for 2025, and it was like, books about that thick. And he said we got 46 pages from Donald Trump with a $5 billion cut to your agency. Like, how do we know the country's being safe? How do we know that we're it's like it doesn't take that much if you cut the fat out to handle things. You just got to do it. Like, all the other bullshit that, sorry, forgive me, that was being put in there, the pork was ridiculous. Anyway, yeah, yeah. Go ahead.
Yeah,
I'll
there
shut up
are
now.
being, the federal government has, last number I saw has severed about 75,000 people so far. Now, that won't show up for a few months because most of those are getting severance pay. They're still getting their salary through September. I believe it's September. So a lot of those will fall off in September.
And the budget for this year is the same as it was last year. Nothing got cut because of they had to pass something. And so the spending is the same this year as it was last year. But 2026 should be a big change.
Yeah. So the other elephant in the room is the Federal Reserve.
Hang on.
Inflation measured
Before you,
by core PCE, which is one of the Fed's preferred inflation measures. Personal consumption expenditures. It's another inflation on how much consumer goods are going up. And it throws
Keith,
being core, it throws out food and energy. So
Keith, this year. Oh, sorry.
it's kind of a basic underlying inflation measure. Now, that's still hovering at 2.6%. It's above the 2% goal, but it has come down from last month's 3%. So we're still seeing inflation, core inflation, decline. Well, the Fed stuck because there's indications, some indications growth could be slowing, but they still are not at their inflation target. So it kind of brings about, stagflation, late cycle stagflation risk, stagnant economy with inflation. Now, some people are expecting, and some on the Fed expect inflation to rise, particularly because of the tariffs. I'm not one of those, but we'll talk about that a little bit more here shortly. Now, what were you want to say, Ellen?
Keith, question.
Oh. When will we start to see the savings that Doge is finding in bad spending? How will that impact us?
That's
We
kind of what I
already
was.
saw it in the first quarter GDP. Government
Yeah,
spending was down 5%.
but I was alluding to that in the fact that they can't change the 2025 budget right now because they had to get it approved.
Yeah, there's some spending that is mandated
Mm-hmm.
that the president can't cut, and they'll have to work that through appropriations. There are some things in the executive branch, like the U.S. aid, the NGOs. He can cut that in halves. Now, if we look at
Now I know
debt
Elon was really kind of not happy about this because they couldn't do it immediately. But I think next year, hopefully, maybe.
well, they're making some changes now. The
Yeah.
debt clock, which gets a feed from the U.S. Treasury, shows so far little over $400 billion have been cut. Now, that's out of a $7-ish trillion budget. But in 3 months, that's not bad. Now, some people will point to the Doge website, which, and I'm not even sure what the number is, 150 billion or something. And it's just different accounting systems.
Right.
Doge, I think, counts cash that has actually been cut as of today, whereas the Treasury looks at like some of the spending that has been cut or canceled had appropriations every month going forward through the fiscal year, and I think that's what the debt clock is reflecting. So there's just two different ways of looking at accounting practices. One is, you can kind of think of it, Cliff Notes version. One is year to date. One would be for the whole fiscal year, which hasn't been completed yet. Excuse me.
I'm going to put this link up there.
Okay.
Oh, shit. Yep, there we go.
Did you get it?
Go, Keith.
You want me to?
Yep. I got it. usdebtclock.org.
That's it. And that's a very interesting site if you like numbers and thinking about, what all's going on.
Yeah, that's the one that Thomas Massey has on his jacket, his lapel, wherever he goes. Is the debt clock that in real time is going through it. It's pretty impressive,
Interesting.
in my opinion.
Yeah. And people, are saying that, Doge is a failure because it hasn't saved $2 trillion. And I know Elon said, that was a goal and he believed he could cut it. The flip side is, does it mean he couldn't cut it? But with the courts and the Democrats, they have run into a very, very determined headwind that is throwing up obstacle after obstacle at cutting costs and expenses. This most certainly is slowing the work, whether you're for it or against it. I'm just saying, when he originally came up with the $1 or $2 trillion figure, I don't think they anticipated having every district judge that had been appointed by Biden ruling against them.
And I don't think that, I mean, I think he could do it in 120 days because otherwise he has to be a federal employee to continue. I also didn't think he would find all those roadblocks, and realizing the Congress has to approve every single. I mean, they hold the.
They don't.
Purse strings.
Huh? They don't.
They don't hold the purse strings.
Well, they hold the purse strings, but the way they appropriate money, there are certain things that they say, okay, the president gets this amount of money for this purpose. Well, he can allocate it and spend it however he wants. That's why Biden was able to move so much money around from FEMA to Ukraine to USAID to whatever. So some of the money is just pooled and given to the executive branch on a discretionary basis. And the president has great influence over allocating that money between certain agencies to achieve certain goals. Now, that's only 40% of the budget, and that includes defense spending, which is a separate line item. But 60% of the budget, which they're also working on some, Medicare, Medicaid, Social Security, they're trying to eliminate, fraud and waste there, not cut benefits.
No.
They'll actually be able to improve benefits if they cut the fraud and the waste to American citizens.
All right. I have to my 50-mile thing.
Okay.
Yeah. I'll be right back. Sorry. I don't know what.
So the Fed was talking about the Fed. They are in kind of a sticky position, and they're obviously not terribly affectionate of Trump. Trump's been kind of hard on them. He's beat them up pretty good, so that's not a close, intimate working relationship there. So the Fed's on hold. Futures markets are pricing in only one rate cut for 2025, which, last December, the prediction was for 6 rate cuts. Each rate cut is 25 basis points. So 6 would be a 1.5% from the current Fed funds rate. Now they're just predicting a 25 basis point cut. Whoops. So the Fed's on hold, businesses are cautious, and consumers are stretched. Not a great combo. Did I mention consumer confidence is tanking? Now that the Conference Board Index hit a 12-year low in April 2025. Now, some people have been fussing about this index, thinking it has a relatively narrow survey and it's not broadly descriptive of all consumers, but it's what we've got. So if you take that to be accurate, it means that regular folks like, you and me are feeling more and more pessimistic about jobs, income, and the future. Now, I haven't done a broad survey of the universe of the, population in America, but I don't sense most people are really feeling pessimistic. We'll see. Now, also, the tariffs are having a big impact on the discourse. And let me update you on tariffs for a second because they are a big driver. In case you missed it, the U.S. rolled out, hefty new import taxes for 2025 on Chinese goods and on Europe. The idea is concisely to protect American jobs, bring manufacturing back to the country. Well, many argue that tariffs make everything more expensive, imports more expensive, from car parts to your iPhone to your morning coffee. All those costs will be creeping up. Now, I've argued overall that tariffs are deflationary. They cause the inflation rate to drop. On the economy as a whole, certainly there will be individual products where the price may go up, but as far as its overall impact on the economy, it'll be deflationary. The thing is, some of the prices that go up, a lot of it's on things that consumers don't need to buy or will easily switch to something else. But the things that they do buy, have to buy, like energy. Energy prices are falling. Gas is down from $75 to $58 a barrel. Tell you, I have another engagement, so I have to drop, but I'll be back for the replay. Thank you. Appreciate it very much, Talia. If you have any other questions, just zip them to me. Hope you have a good rest of the night. So oil prices are dropping. That impacts everything. Food prices are dropping. So we are seeing already some significant deflation in the critical elements that impact most everybody's prices and lifestyle. If the iPhone goes up 10%, it really doesn't impact most people because you don't buy an iPhone every couple of years. And even on the iPhone, Apple has stated it's moving production to India and will import all the phones from India to the U.S. to meet the U.S. demand, so prices won't change. So, people are going, the iPhone's going up to $9,000. That's just hooey. There'll be some companies that eat the cost of tariffs. That may squeeze their margins, but many of them have had rather huge margins to begin with, as with the designer items. We've all seen how all the designer labels were actually having the products built in China. Now those Chinese manufacturers have been online advertising a Burberry purse for $20. And it was what, $800 or $1,000 in the stores? So some of them have had pretty huge margins to begin with. So the net effect on your spending, I predict, will be marginal, if any. Now, let's separate the narrative from the reality because media headlines don't help. There's really two different sides. One, it's just a soft landing. That's the optimistic take, that growth will slow, inflation cools, and the Fed cuts gently. Everyone lives happily ever after. The only problem with that is we've really never had a true soft landing without something breaking. The 1994 cycle came the closest, but even then, bond markets panicked. Mexico defaulted. So I'm not going to say it can't happen, but if you're a betting man, let's just say history shows it's never as soft as what we would like. On the other side, you've got It's 2008 all over again, another subprime crisis. And, all I can say to that is no, it's not. We are not seeing systemic banking risk yet. The housing market isn't subprime fueled. Consumers aren't over leveraged in single family homes, the way they were. Doesn't mean we're in the clear. There's some problems. Multifamily units, their defaults are up to a 2007 high. These are from 2 to 4, maybe 6 apartment units, small units, townhomes. Also, but their defaults are up. We mentioned a couple of weeks ago that the FHA, their default rate is up to 13%, and they are ending the program that has been eliminating defaults and bankruptcies for 3 years. Some people have lived in their house for free for 3 years. The FHA will pay off their amount in arrears, the amount that they haven't been able to pay or paid, and then add that to the loan. So they get to continue living there. They owe more, still can't make payments, particularly at the higher payment amount. So the FHA, Freddie Mac, steps in again, makes another payment, adds it to their loan balance. They get to live there for free. So that's been going on for 3 years, and that program's coming to an end. And it's not going to be pretty for the people that have been able to take advantage of that. VA loans are up a little bit, just under 5%, but both are increasing. The big picture of that is that FHA only makes up about 15% of all mortgages. So that's only 2% overall delinquency rate, which is pretty manageable. In addition, you've got to keep in mind that now 40% of all homes in the U.S. have no mortgage. And a large number of the remaining have a 3% mortgage or less. So most of those are doing okay. And just to give you a comparison, in 2008, 23% of all homes were underwater. And we're looking at 2, 3, 4%. The average loan to value back then was 85%. Today, it's about 46%. So now, flip side is that if home prices crash in a lot of areas, that ratio is going to change. But anyway, we're not there yet. It's not even close to being 2008 levels of harm, danger, or risk. So to give you a little bit better perspective of the trends in foreclosures and bankruptcies, a picture can tell the story of 1,000 words. And I hope you like that picture, because it be gone. I don't know what happened to it. Okay. Well, anyway, too bad E-Train's not here. She would give me hell for this. But it was a graph showing the foreclosures and delinquencies, from 2006, 7, and 8, which formed a sharp peak. Obviously peaking in 2008 or 9. And then it declines 2013, 14, and then it starts rising slowly to 2024, where at the end of or middle of 2024, it started upticking some, and then at the end of 24, first quarter 25, it's gone down. So, it doesn't look like anything is about to explode just based on the picture. And that kind of reduces the risk of any systemic banking crisis, Yeah, it's more like a slow bleed. Something like what we had in 2001 is possible when the dot-com bubble was bursting, and then 9/11 hit really hard for a few months. But more, what the data is showing now is more of a slow bleed rather than a impactful crisis, huge crisis. Keep in mind, even though there was a slow bleed, what I describe as a slow bleed, Nasdaq still fell 78% during the 2002 tech bust. So, the market can still have strong reaction. I doubt we'll get that this time, but that is the history. Now, there are other red flags in the economy which need to keep an eye on, and I try to keep an eye on for you. Auto delinquencies are up. They're still low, up to about 3.25%, up from 2.6 at the beginning of 24. And most of those are subprimes. Yes, banks were making subprime auto loans, small amount, it's a low percentage of the total. But there is a bubble. And shoppers to get a car have to take out a larger loans than ever before, thanks to Obama's cash for clunkers. Do y'all remember the cash for clunkers? It took a lot of cheap, reliable cars that you could fix yourself off the road, which still irritates me to this day. But the key is 1 in 5 car shoppers, 1 in 5, have a loan payment of $1,000 or more a month. The average payment's risen from $570 a month in 2019 to $760 a month in 2024. That's a 33% increase in 4 years. So that hurts. Consumer credit card defaults, not delinquencies. Keep in mind, I'll use these two words: default, which means they're actually, bankrupting on it, or delinquencies. They've missed payments. Consumer defaults, credit card defaults, have risen from 6% to 7.2 over the past year. That give you a relative score. That's back to 2013 levels. Okay. And if you look a little deeper, those delinquencies are up across all income levels. The top 10% wealthiest zip codes, delinquency rate rose from 4.8% in 2022 to 8.3 in the first quarter of this year, a 73% increase. And that's the wealthiest zip codes. The lowest income, the bottom 10% zip codes, the delinquency rate has jumped from 15% in 2022 to 23%, just under 23%. That's up 53%. A 23% delinquency rate. That's painful. So if you've got a bank that has a huge slug of credit card loans as a percentage of its portfolio, you may want to think about switching, reducing that risk, let's say. So the risk, though, is not systemic. It's not at 2000, again, doesn't present the risk so far that, we saw in 2007, 2008. Banks have tightened standards, credit card lending standards, and continue to do so. So they're reducing their exposure. But credit card delinquencies are at a 5-year high. That can't be ignored. Welcome back.
Hey, thanks. I had to check on Mahoney and give her some kitty crack.
She doing okay?
Yeah, she's still in the huge poof, but
Okay.
thanks to Melissa, this is her
She
kitty
loves
crack
that. Absolutely loves that.
from Trader Joe's. Oh my gosh, like it's crazy how much
Yeah,
she loves
she
it.
will start demanding it if she knows you have it.
That's why I keep it in a drawer.
Um, Another, consumer credit thing that is problematic or about to be problematic, student loans, about to be a mess with a capital M. So many of those loans have been, the payments have been waived over the past several years, and the borrowers did not have any appreciation or understanding that the interest was still accruing. So now they're finding out that they owe more than what they borrowed, and the payments have gone up significantly.
May I interject
Certainly.
quickly? Okay. This also was a thing for car payments. Any other loan that you had that you deferred, especially during COVID, including car payments, which I have a friend or two that decided to defer their car payment and now they're having $800 car payment as opposed to the $600 car payment. And they're like, I just thought it would just kind of like go away. Like, that's not how that works.
Not how that works. Too many people simply have no idea of the way debt works, and they're mad as hell about it.
Hmm.
But it was their decision. And I
Stupid should
think
hurt.
that's evidence that a show like Moffat on Money is valuable. I'm not trying to necessarily toot my own horn, but that's something that we work on and try to educate people on and give you tools to help you make better decisions.
You mean
It's,
if they deferred? They deferred the
yeah,
interest to the back of the loan? Yeah.
I can't claim that it's as entertaining as, some other dramatic shows, but it will help you make better decisions. So, uh, one other area, uh, two other areas, I'm going to lump them together where there could be some damage as well, are ABS deterioration, ABS loans, asset backed securities.
What is that?
Uh, Banks, you know what a mortgage backed security is?
Hmm.
Um,
So if I
it
took a
just
loan on
uses
my
other assets like
took a loan
car
on my
loans, credit
car.
card
Yeah,
loans,
okay.
student loans.
Gotcha.
For those of you who may not be familiar, banks make loans. It could be a student loan, car loan, trailer loan, whatever, credit card loan. Well, the bank doesn't really want to keep all those loans. So what they do is they bundle them up and sell them to a trust. The trust gives them cash. They're able to take that cash and lend it out more. The trust takes all these loans, student loans, credit card, whatever, and assembles them and then sells shares of that in the market. That's called an asset backed security. So you can buy a share of a credit card pool of loans.
Now, is this just real quick? Is this on okay? Except for I know you just said credit card. Except for credit cards and um, education student loans, does everything else have to have like a title where there is an actual asset?
Probably. I mean, auto loans, trailer loans, home ec loans. Um,
ELOC.
yeah, all of those are titled assets. But the bank now in HELOCs they will, but in most of the others, home loan, auto loans, well, they do assign the title in that as well. So yeah, I think probably. I can't think of
Okay,
one
so
offhand, but I won't say there isn't. But
I,
credit
I don't.
cards, student loans are not titled.
Why would anyone buy someone else's credit card debt as a investment?
High risk, high return. The yields
If
on
it,
them are higher.
I would short it if anything at this point.
The risk is defaults. If you are
Right.
able to buy, a credit card loan and there's very few defaults, you get a higher rate. If defaults go up much, you take it on the chin. So it's just risk and return.
Can you short those?
Yes, you can short most securities through credit default swaps. We've talked about those a little bit,
Mm-hmm.
but it's kind of like buying an insurance policy on that particular bond or debt, and you'll pay premiums every quarter.
Okay.
And as long as you pay the premiums, you have
What
that
is a
default insurance.
what is the premium for what? Like if I say, okay, let's say American Express, I don't even know if this is how this works. I'm just throwing something out there. Is, selling some of their debt is that how that works? Their credit card debt as a security or explain that.
Well, it can be any kind of debt. It can be, specific to a company, like a bank. Remember when Bear Stearns defaulted, went bankrupt back
Mhm.
in 2000 and early 2007, I believe.
Mhm.
Well, they had some credit default swaps held against their debt. So when their bonds defaulted, those credit default swaps paid the holders the face value of those bonds. And you ask what the
Okay.
premium was. The premium
Hang
is
on.
going to
Hang on.
vary from asset to asset. And
You
it
got to
could be
back up.
something like 40 to 80 basis points a quarter.
You got to back up a little bit. The oh gosh, the default swap, you have to give us a scenario. Like how that sounds like very technical.
Did you see the movie Big Short?
Yes.
Remember Michael Burry and what was the
Mhm.
other guy's name? The two guys that thought it was the whole industry was a fraud.
Yes.
That's what they were buying when they figured out that it was
They
hokey. They
shorted.
bought credit default swaps.
Okay, what is a credit default swap? What is a definition? Can you give us
It's an
like a
in
layman's?
think of it as an insurance policy
Okay, again, how you got to break it
for the
down.
for the company going bankrupt.
An
Company issues
insurance.
bonds. If they go
Mhm.
bankrupt, they no longer make payment on those bonds. The value of those
Are
bonds drops to zero.
are those government bonds or those
No,
bonds
those are
just for the
company
company?
bonds.
Okay,
Company
that's what
bonds.
I'm trying to clarify these little
No,
terms.
you're fine.
Okay.
So if the bonds go to zero, the credit
Mhm.
default swap pays the full value of that bond to the
So they
holder of the
shorted
credit default swap.
the bond.
Pardon?
They shorted the bond
It is a way of shorting the bonds.
by buying the insurance on the bond, but you have to have the bond to begin with. Yes, no.
Yes.
Okay. I'm trying to simplify for me and anybody
It's
who.
fine. You're doing fine.
Okay.
All right. I'm going to get off this slide before Ellen notices my picture's not there.
I'm going to mute for a sec. Hang on.
Okay.
Go ahead.
Now, this actually is the picture I was describing. So there was another picture on the previous slide. Trying to remember what it actually was. Anyway, this isn't the first time we've seen this play out. In 2018, under the first Trump administration, we had tariffs, had kind of a trade war. The economy started booming, was growing at near a 4% rate. At that time, the Fed got scared of potential inflation, so it started hiking rates. It hiked rapidly to prevent inflation because the economy was growing so fast. Markets got jittery. The yield curve inverted. And when I say inverted, that just means that the short-term rates were higher than long-term rates. Normally, short-term rates are lower than long-term rates. It's an upward sloping curve, yield curve. The interest rate for a 3-month Treasury note is lower than the interest rate for a 10-year Treasury note. Well, that inverted. The 3-month was actually higher than the 10-year. When that happens, that's generally a pretty good recession predictor. Well, everyone freaked out when it inverted, but we didn't have a recession, not until COVID did the trick in 2020, 2021 with the lockdowns. To me, 2025 feels different. I mean, we've got extra baggage this time. China's economy, as I've described, is collapsing. Now, I saw the WTO, World Trade Organization, put out a projection for China's economy this year growing at 3%. That's just, I'm sorry, it wasn't the World WTO, it's the IMF, International Monetary Fund. But that's so hokey. They're having serious deflation. And workers, haven't been getting paid or finding jobs over the last year, several years. It's just, China's just in a mess. Factories are shutting down. There's no way in hell they're going to see 3% growth this year. Europe is a mess. Germany's government is, kind of in chaos there. Eurozone has a measly 0.8% growth. And I saw earlier, before the show came on, the White House announced it had reached some trade agreement with China. That was quick, particularly if you have watched the show. I have repeatedly held the view that the administration is getting exactly what it wants out of China. They know that its economy is collapsing. They know they're having civil unrest. They know that they're having huge financial difficulties, and they want to magnify that. They want to crush China as an economic and military competitor. That's still my view. This agreement, details are supposed to be released tomorrow. So we'll see what's in the agreement. But, I'm a bit skeptical. I think basically what it's going to be is an agreement to continue talking in some shape, manner, or form. There's some overall framework to continue discussions, maybe targets, areas of interest, whatever. But I am in Missouri thinking that, hey, an actual trade agreement is done. The trade war is over.
You're not in Missouri.
I've got one big foot in Missouri. I don't think we have reached a trade accord with China.
No, we have not.
But the White House announced this evening that there was some trade agreement. And so, I was looking at the futures markets before it came on, and they were all, jumping. And I'm like, that's just kind of stupid. Right now, I'm looking at them. The futures market for the Dow's up 400 points. S&P's up 75. Tech stocks are up 350. So they're up about 1%, 1.5%, which is a pretty solid jump. But I think they're in for disappointment. Right now, the U.S. holds all the cards. Our economy is still doing okay. There's, no real red flags popping up. I even look at cargo, and you see the director of ports of, LA or Seattle talking about, in 2 weeks we'll be empty. And then I look on the internet and I look at the number of cargo ships from China heading to the US. 52, 55 ships, the highest for this month in 5 years. And I'm like, hell if I know. But right now, there's no shortages, there's no empty shelves, there's no, prices going up. The US is doing okay. China is the one tripping all over itself.
Yeah. I have seen people using that to up their prices, going, the tariffs are killing us. I'm like, okay.
I haven't seen or noticed anybody raising their prices. I'm not going to say there isn't, because I'm sure probably some are, but I haven't seen anything. So unless China agrees to give Trump everything he wants, which I don't see them doing, but unless China agrees to give Trump everything he wants, I don't see a quick agreement. And China is not going to agree because they will lose face. And if you have any familiarity with the Oriental mind, losing face, they would probably rather die than lose face. It's that big. So I don't see them just folding. And Trump and the Senate hold all the cards right now. Now, in 3-6 months, if the shelves are empty, if people are starving, if, unemployment's 9-10%, that may change. I don't think that's going to happen either, but I'm just saying right now, I'm skeptical that a real agreement has been reached. So what do you think? You think a recession's coming this year?
I do.
I don't think we've already been in one, but let me know what you think. Do you think it's coming by year end? Do you think maybe in 2026? Do you think we're already in one, or do you think it's just hype? Curious. All right. Let's kind of shuck it down, bring it to the kitchen table, I guess. Simply can't control Jerome Powell. He will do whatever he wants. Can't worry about Jerome Powell. What we can do is control our cash flow, our portfolio, our risk exposure. So here's kind of a game plan that I think is reasonable. If a recession is coming, if you're concerned about a recession, then liquidity is king. You want to try to build or maintain 3 to 6 months of expenses in a convenient savings account. You can still get 4 to 4.5% in many banks. So don't put it in one at 0.5%. You're just getting robbed. Avoid new debt. Trim your spending, and particularly no variable rate debt. That will be a killer if the Fed decides to hike rates. Delay large discretionary purchases unless they are deeply discounted and really offer you some true value. And the key is it's not about austerity, it's about agility. It's about having the ability to move and take advantage, exploit opportunities that will arise. If we go into a recession, opportunities will arise. Um, Also, job security. Here's the hard truth that layoffs generally tend to target the replaceable. So, how can you try to guard against that? Well, make yourself visibly valuable.
And invaluable.
Build reports, mentor others, ask to own some new responsibility or to
Do
take
more
care
than
of
you're
something.
expected.
Yeah. You also want to try to diversify your income if possible. Freelance, consult, teach, learn new skills. Learn new skills.
Jane,
Update your resume now, not later. Be on the lookout for opportunities if you're feeling greater uncertainty at work. Don't wait till you get hammered to try to prepare. Go ahead and update your resume now. Jane, Walmart and other retailers are already shifting gears to made in America. Yeah, that's true. I saw, and this surprised the hell out of me, Temu, which I've never bought, but I'm vaguely familiar with them. But they said they are shifting their goods to made in America, which I don't know how, considering the quality of their goods, but nonetheless, that's what they're doing. So, it does look like there is over the next decade going to be a significant increase growth in American manufacturing and opportunities in that area. So that's where, improving your skills becomes more and more important. Improve your value. It would help you possibly survive a layoff or enable you to get another job sooner. If you're the only one who could fix some sort of in-house reporting software or streamline the process or simplify the whatever, improve the process. That online course you took could be the best return on investment of your life. So always look to learn or expand your skills. If you're not, you're doing life wrong. In terms of investing, and I'll say this, I do it myself. I've got a good job. I'm in no fear of losing that job. I make good money. I'm taken care of. But I still am try to learn new stuff. I took a welding course, this past year, and am real close to buying my own welder. So it goes for me as well as for thee. In
mm-hmm.
your investments, some people are concerned about risk. I mean, everybody's concerned about risk, but some people really are just uncomfortable with risk. So for those interested in market defense or defensive strategies, your rules are relatively simple. One, never panic sell. If you're long term, see corrections as opportunities, not curses. Warren Buffett was oftentimes quoted as saying, if I buy a stock and the price goes down, it just gives me an opportunity to buy a stock that was already valuable at an even cheaper price. Bingo. Focus on quality. So many people try to find the next great home run. No, just no. Focus on quality. Cash generating companies with low debt, strong pricing power. They're not in a market where there's strong competition or substitution opportunities. They make a product that people want at the current price. Also consider dollar cost averaging. This is just putting a fixed amount of money in the market every month. Even if you just put it into a cash account or savings account, and then you buy when the market dips or gets weaker, which it goes up, it goes down. Buy into weakness. You won't catch the bottom, but you'll do a whole lot better at smoothing out the risk. And if you own speculative assets, volatile assets, reduce your exposure. The best portfolio managers I've known have very little downside risk. Warren Buffett said, Druckenmiller said, don't take losses. If they see something as increasingly risky or overpriced, some people think, oh, it's gone up 30 or 40%, maybe it'll go up 50 or 60, and so they hold on to it. No, you've got a good gain. There's no such thing as a bad gain. Things that go up quickly will fall quickly. So, and for some people, even bonds are, finally attractive if you're, very risk adverse. Intermediate term treasuries, I'm talking something with a 3 to 5 year maturity, now pay around 4.25, and have far lower volatility or risk than stocks do. They're not sexy, but they are sleep friendly. And for some, safety is more important than absolute return. Looking at the stock market, the main market, the S&P 500, it's down 3% year to date. Obviously, it was down lower. It's come back up some the past week or two. But the thing is, that's what markets do. If you're in the stock market, you have to accept some of that fluctuation. You'll never time it. So the stock market, a lot of people think the stock market's been hammered, but it's not. It hasn't been. It's not a bloodbath. Not yet. Still, some sectors are in the crosshairs more than others. Tech at the top of the list. Why? Well, if you look at companies like NVIDIA and Amazon, they have sky-high valuations. The NASDAQ, which is a mostly tech index, tech company index, has a price to earnings ratio of 35, which means for every dollar of earnings, investors paid $35. Normally, that's around 20 to 22. That's pricey. Tariffs aren't helping. So, higher cost for chips, possibly reduced availability for some chips and components can hit tech pretty hard. In 2019, Apple's stock dropped 10% when tariffs disrupted their supply chain. Of course, it bounced back quickly, but I'm not saying sell your tech stocks, but if your portfolio's, all in on growth, you might want to think that if you're concerned about risk. Another area to be careful with is consumer discretionary. Companies that sell to consumers on whimsical goods, like Nike or Starbucks. Those are luxuries, so to speak, not really necessities. Even a lot of Walmart sales are whimsical. People think, oh, hell, I just need a new TV. And they'll go down to Walmart and buy one. With consumer confidence at 12-year lows, with the job losses, people are cutting back spending. So that normally does not bode well for discretionary consumer company. A good index is how many of you have been to the mall lately? Yeah, I don't
Not
go to
me.
malls, but it's not a horrible barometer of the retail market. It, if you go to malls now, they're empty. They have no vibe. They're kind of grim. Fewer shoppers, more sales signs. People are skipping Starbucks to save $5 a day. That kind of belt tightening hurts stocks, but it's not all doom and gloom. There are
Are you
safe
sure?
havens. What?
Are you sure?
I am so sure.
Okay. You
Uh,
say so.
there are safe havens and even some winners. Dividend stocks, for example, utilities like Duke Energy, or consumer staples like Procter and Gamble. How many people are going to quit buying dishwashing soap because they're having to cut back spending?
Because you can make it on your own. I'm just saying.
You still need to buy the soap.
I mean, I guess. But I
Hell,
mean,
they're
you
even
can make
selling
it.
the borax if you make your own clothes washing soap, whatever.
I'm
But
just
these
saying.
companies pay steady dividends, 2 to 3% per year. It's kind of like rent from a reliable tenant. And if you want some history, in 2008, when the S&P crashed 38 to 40%, I forget offhand, utilities only fell 29%, and the staple goods held up even better. Now you think 40% versus 25 or 30%, it still fell, but it vastly outperformed the other stocks. Um, Cautious investors who shifted to some of these high paying dividend funds or ETFs slept better during that year's market dip. Some people have asked me if it's time to double down on those kind of dividend paying investments, and I'm kind of halfway tempted to say yes.
Really?
Yeah, I mean, if
Okay.
I'm talking about for cautious investors that don't
Right.
like risk. I kind of like risk, and so it's not necessarily what I would be doing, but I'm trying to kind of give people at different places suggestions on what
Fair
might be
enough.
comfortable and best for them. So, looking forward, bonds, intermediate short term bonds are another safe bet. 10-year treasury yields that I mentioned previously at 4.2%. That's a decent income, pretty close to the historical norm. And if the Fed does cut rates,
Mm-hmm.
bond prices will rise, giving you kind of a nice bonus. Back in
Fair enough.
2009, when rates fell, bond funds gained 6%. It's not sexy, but it's steady. Uh, so there are, manufacturers, domestic manufacturers like Caterpillar will benefit from tariffs. Caterpillar's main competition is what? Kubota, and there's another Mitsubishi. Is it Mitsubishi? I forget who else makes tractors. There's a Chinese entry. Well, if they're getting hit with
John Deere.
tariffs, well, John Deere doesn't make the big Caterpillar
True.
tractors,
True. I was just being funny.
bulldozers.
Sorry.
So they face less foreign competition. Tariffs would help them. That might be something you want to look at. Industrial
Mm-hmm.
stocks, as a rule, rallied pretty strongly during the tariff frenzy. Um, so if you're looking to play, a little offense but keep with something safe, those are worth a look. Now, I've also listed here several dividend ETFs. ETFs are kind of like mutual funds, but they trade on the stock exchange like a stock. And, these are kind of my top 5. And I'll keep it simple. You've got Vanguard's Dividend Appreciation. The ticker symbol is VIG, VIG. So if you want to look it up, you can just, ticker symbol VIG. The yields right now are just under 2%, and it focuses on companies with growing dividends. Now, it buys the stock, but it buys dividend-paying stocks. But it's looking for dividend-paying stocks that still will appreciate in value over time. So kind of a double whammy. You have the income stream, which helps make it a little bit safer, less risky. Plus, you have stocks with higher appreciation value. Schwab U.S. Dividend Equity right now yields about 3.5%. This is one of the higher dividend paying funds. It's heavy on staples like Pepsi. Now, Pepsi isn't going to increase its market share. Coke's not going to increase their market share anyway, but they pay a good dividend. So if you're looking for steady income with some small chance of capital appreciation, if the whole market goes up, they're going up. Not as much, but they're going up. That would be a good choice. Third, I've got iShares Dividend Growth. Yields about 2.4, 2.5. Blends, it's kind of a more balance between growth and income. The Spider Dividend ETF, SDY, yields 2.6%. And it loves what it calls dividend aristocrats. These are companies with 25 years or more of consistent dividend payouts. And then the last one is ProShares S&P 500. They even call it the Aristocrats ETF. That's funny. The ticker symbol is probably my favorite, NOBL, Noble. It yields 2.1, and again, ultra reliable dividend payers. A very, very conservative fund. So these funds are like tortoises in the race. Now, the Vanguard and maybe the Dividend Growth give you a little bit better opportunity for appreciation in stock price value as well, but still relatively safe. So you can search those tickers and find out additional information on them. Now, let me make this point, and this is important. I am not making any specific investment advice or recommendations to anyone. I'm just saying, if I was a conservative individual concerned about risk, these are some of the dividend paying funds with some upside that I would consider. Also, secondly, I don't get a dime from any of these or anybody associated with these. I will have zero connection with anything you invest if you invest in them. Not a penny. So I have no particular interest in you investing other than what's in your best interest. Now let's get skeptical for a minute on this strategy. Are dividend stocks and bonds really safe? Depends on what happens to inflation. If inflation takes off, probably you won't have the returns that you would prefer. Now some of the, I looked on different investor sites, like on X. One of them was Steady Investor, and they swear by utilities, saying they're my rock in every crash. Others are strongly talking up gold or crypto, Bitcoin. Gold is up 15% this year. Gold is tempting, but it doesn't pay dividends, and the prices jump. So, some people think it's a little bit pricey now. Crypto's another alternative, another wild card. I mean, Bitcoin's volatile, though not as much as it used to be, but it's gone from 92 to 104 in a couple of weeks. Been a good, some good volatility there. So those are some alternatives, but they don't pay dividends and will be probably a lot more volatile. So if you hate looking at an asset you bought and seeing the price drop, those are probably not for you. Now, I try to follow trends in the economy because I think ultimately the market will follow. So kind of going to get super practical here. You've heard of the risk.
Y'all are in trouble now. It's getting practical.
You've heard of the risk, tariffs, the Fed, global slowdowns. We've talked about all that. And you've seen how markets are reacting. But let's talk about you. How do you protect your wealth and maybe even come out ahead? So, I've gotten some emails, DMs. I get a few questions. So I'm just going to throw some of them out. First, I'm 45, single with 120,000 in 401k and 20,000 in cash. Should I move everything to cash? Short answer, probably not. If your timeline is 15 plus years, you want exposure to equities. You want to be in stocks. You may want to rebalance some of your equity position. Maybe shift 10% into, higher dividend paying stocks, maybe bonds. But over the long haul, you're going to be far better off in equities. There's usually a big regret story if you don't follow the market closely or if you hate trading, if you try to time the market and move in and out. So for most people, I don't recommend that. Stay invested. You'll be better off in the long run. Question, we're thinking of buying a house this year. Rates are at 6.8%. Should we wait? Answer is, I would suggest that you only consider buying if you're going to stay put for 7 to 10 years. And you can make the payment fit your current budget. Don't stretch yourself.
No.
Don't count on some future raise. The rates are a little high now. Housing prices are starting to fall in a lot of markets. And, job losses are picking up. So focus on your monthly math and your stability. It's highly likely in most markets that housing prices will drop over the next year, my opinion. Had another person ask a related question. Is housing a good hedge for 2025? It's a great question. A lot of people love investing in real estate and they've made good money. Real estate is generally stable. I mean, home prices are up 4% over the past year, but it's highly illiquid. You can't sell a house quickly if you need to, like you can a stock, if you need the cash. That's it, Mahindra. Couldn't think of
Jane's
the name.
always got it.
Started with an M. Now you could consider some REITs like Vanguard's real estate ETF. They yield about 3.5% and diversify you. But keep in mind, on a national basis, a lot of investors are dumping real estate. So I'd be very cautious about investing in real estate right now. Location is everything. The big problem with that is being able to predict which locations will be the most valuable going forward. I mean,
Truth.
for 200 years, Manhattan has been going up in value until the last 5
Until,
years.
yeah, that's the issue.
Office buildings in downtown areas of most major cities are selling for 50, 60, 70% discounts now. That's a huge loss. So, timing, 3 most important characteristics in a real estate purchase: timing, timing, timing. Another question. I got a bonus. Should I invest it or save it? That's like throwing blood in front of a shark.
Oh, geez. I know, right?
If you have a sufficient rainy day fund, then invest it. The difference in return will be significant over time. Now, we've talked online about using online financial calculators and have even showed people how to use them before. Let me do this. This is, no thanks. This is one that I recommend. This is actually run by the Securities and Exchange Commission, so you don't have to worry about, any hokey stuff, I guess. But it's very simple. You think I can invest in a 3% savings account, or I could invest in stocks at 8%, maybe a little bit more aggressive stocks at 12%. Which one should I do? How do I feel about the risk? Well, let's just give an example. It's real easy. I've got an initial investment today, $1,000. I am not going to contribute anything else to it monthly. Length in time, I'm 35, so I want to have it by the time I'm 60, so I've got 30 years. Estimated interest rate. This is the one that you'll keep changing. Okay, I'm going to start off at 3% savings account. So annual interest rate, 3% per year. No variance, don't worry about that. Compound frequency, I'm going to leave it annually. So calculate. It does the wonderful math, and at the end of 30 years, I have $2,400. Starting off with $1,000 over 30 years. Well, let's say, okay, well, that's not great. What if I put it in a dividend fund and I earn 8% per year? What does that turn into? Well, that takes it up to $10,000. That's a little bit of an eye-opener. And then you think, well, what if I just invested it in stocks like the S&P 500 and I earned the 75-year average at 12%? Calculate. That takes it up to $30,000. Okay. Now you think, well, okay, that looks like that'd be better for my retirement. But what if I can also add $100 a month to it? And I need to change this to monthly because I'm investing monthly. So calculate, and that turns it into right under $400,000 in the end of 30 years. So this is a great tool. Here's the graph showing you the difference. And the graph is, I love a picture. I love graphs. And you'll notice the first 5-10 years, there's not a big difference between the two. But as you go on, as that interest accumulates and you start earning interest on the interest, that's when you get this exponential growth. And, that's why I say it takes one of two things to make money. It either takes money or time. And if you don't have a lot of money, most people have time. And you need to take advantage of that. But this
Heck yeah.
calculator, it's simple to use.
What is
How
this
much have
one?
you
So
got
I can put
today?
it up.
Yeah, it's
Investor.gov.
just I'll post it here.
You got it?
Yeah.
Okay.
And you can just search, go to investor.gov and it will, you click, there's a financial tools and calculators. That specific website. Oh, I'm sorry. I want the compound interest calculator.
Yeah. Yeah. You have that on here. But if
Yep.
you are investing, that's the one you want, compound
Yep.
interest.
So it's a great tool for you to do what ifs and try to determine, do I want to go ahead and, spend this money at Starbucks? $5 a day for 30 days a month is $150. What if
Yep.
I, cut that down to once a week and saved $100 a month and invested that $100 a month?
It
You
makes a
make the
big
choices,
difference.
but at least you can do it on an informed basis, which is kind of what we're all about. You make the best decisions for you.
And please, if you're a mother and you have children, send this to them. At least this
Teach them
part.
to use it. Yeah,
Yes.
get them to watch the channel too.
Oh, well, that, but also like it's so much wiser to invest than to buy the next thing or have the next best thing or the newest phone, whatever. Just look out for your future. At least try
Yeah,
to get them
understand
to.
what you spend today on a depreciating asset you will not have in the future.
Mm-mm.
Um, all right, one more. Another question I got was, should I sell my tech stocks? And that's kind of tough. Tech is been shaky with the tariffs and high valuations, but again, my advice is don't panic sell. If you feel like you're overexposed, if you feel like if you've got more than 50% of your portfolio in tech stocks, if you'd feel better, safer, move some to dividends or bonds. Remember, in 2022, panic sellers locked in losses, while patient investors recovered by mid 23, 24. Tech has a bright future, has ever since it was invented. There are several good tech funds out there, and there's some individual companies with huge promise. I think Tesla has an extremely bright future for one. Tesla is no longer an EV company, and it will be even less so going forward. It's a robotics company. It's an AI driven company. It's
True.
um, these robo taxis. Their technology is so far ahead of everybody else. Their taxis now are capable of driving around, finding a parking place and parking. And then it knows the meter it's at and it can pay the meter. Nobody else can do that. The cars maybe can drive around okay, but they can't park themselves. They can't go in a parking deck, park themselves,
Yeah.
pay.
I get in
Um,
California, that might be like, I've heard it's awesome, but I'm like, that would just, for me, in my circumstance, it seems weird. Like,
yeah, yeah, but think of all the people in New York, Philly, Boston, Chicago who
oh
commute
God,
an
yeah.
hour or two to work
LA,
every day.
whoever. Yeah,
They
absolutely.
can be on their computer doing work, checking news, overseas, preparing to present a report, whatever,
And like I
instead of
say,
having to
perspective,
spend
yeah.
an hour or two
Perspective's
driving.
everything. Yeah. Because it's where you are and what your situation is. But
Yeah.
that to me that just seems so weird.
but there are millions of people who would love to have one of those cars.
Oh
Taxi
yeah.
services would buy them out the wazoo because they would get to keep 100% of the rates versus whatever fraction they get now.
Oh yeah.
So huge demand for that kind of car. Huge demand for their robots. And we've talked about that before, but they've perfected the robot to where it now can adjust the touch. That's always been one problem with robots, like in Amazon plants. They
Mm-hmm.
might grab some things too hard. They have no sensitivity. Well, now they've figured out how to make the robots sensitive to the item that they're picking up, so they can adjust the pressure.
Good. Because I ordered some air filters, and half it was like something came down on one side of it
Yeah,
and just crushed. I was like, okay, that's not cool.
yeah, that could
I
be in
guess that's what
shipping
you're
as
talking
well.
about. Well, it could have been, but it's like it said fragile. But just
Yeah,
one divot, actually top and bottom on one side. This was like months ago, but makes sense now that I'm thinking about it.
yeah. Now that doesn't bode well if you're a warehouse worker at Amazon,
No.
but if you are buying the company that is manufacturing the hundreds of thousands of robots for all these different uses, you're probably better off. Um, and I'm always leery of individuals buying individual companies. Buying a good company is easy, particularly if the market's going up, every company goes up.
Mm-hmm.
But knowing when to sell it is always the problem. People get attached to stocks. They think it's gone up 30 or 40%. It's going up even more. And then it dumps on them. Buying a company is easy. Knowing when to sell it is the tough part. So I usually recommend most people, who are in that market, utilize people who are in that market segment full time, like tech funds, mutual fund managers. There's some good tech funds out there.
All right, Moffat.
Oh, I've gone a little long, haven't I?
Yeah, what is that?
Well, the point of this was to stay flexible. And when I
Is
Googled flexible, this is what came up because I
that
had
is not
no
a
idea
human? That is like two
that
humans, right?
no, that's one human.
No way.
That's a
No, you
gymnast.
can't. You can't do that. You cannot do that. That is not no. That is an AI. That is something freaking weird. No,
Nope,
you can't tell me that her or not her and someone else.
that's her.
No, it's not. It's AI. It is some confounded. Okay, I quit. I quit Moffat on money right now. No,
All
that is
right.
not a thing. That is some okay.
Well, let me just
That
throw out real
hurts my
quick
feelings.
some of the mega trends. What mega trends will
Mm-hmm.
shape the rest of 2025? Deglobalization. I've talked about for 2 years how globalization was kind of stupid because we shipped cotton and money overseas to China. They make the shirts and then ship the shirts back. That's kind of stupid when we can build a little plant not much bigger than a house next to the cotton fields in Alabama or wherever, and with robotics now manufacture those shirts cheaper than they can in China. So globalization is kind of dying in a lot of ways. Um, Deglobalization is a trend. U.S. firms reshoring to Mexico, Vietnam, even stateside is a trend, moving out of China. AI, robotics are a trend. Um, they will greatly make people more effective, um, more efficient, I should say. Trade tensions with China are going to remain high. China wants to destroy us. We're kind of getting the same view. You've got the India-Pakistan war going on. We're backing India. They're backing Pakistan. That's going to add to some tensions. And then political uncertainty. Might as well get used to political uncertainty. And, some people will blame it all on Trump. No, if Kamala Harris had won, then all of the Trump supporters would be mad and yelling and hating, growth in government increasing, bureaucracy, whatever. Each side is not going to be reconciled to the other side. So you might as well get used to increasing political uncertainty.
Okay, I'm mad at you and Roger right now. He's like, that's real. I'm like, no, it's not. It's not freaking real.
That is real.
No, no. The skin color doesn't even match.
That is her suit.
No, okay, here, you can't see what I'm pointing to. Her legs and then her arms underneath the suit do not match. No.
Yes. Well,
No.
she's got a bandage on this hand. This is an elastic bandage.
Okay, see her hand and then her legs and her face.
Yeah.
That is not her.
Okay. Go right on with
That
it,
is
E-Train.
That is
Now,
messed up.
All right, let me try to get through some of these.
Okay. I am going to bow out now because I can't look at this anymore because I love you guys. Y'all are the best. Moffat. Mwah. To everyone, good night. That's just I have to look this up now. Good night.
Good night. In terms of jobs, labor displacement with AI, robots, supposed to drive productivity miracles, but it's also driving redundancy elimination or job displacement. White collar, knowledge based roles are, previously considered safe or at risk. If you've been, for example, managing customer service. Well, AI is getting to the point where it can handle complex customer service inquiries, reducing the need for human reps. That's obviously going to impact some of the managers as well. I just saw where a company like Klarna replaced 700 customer service workers with an AI assistant and claimed a 75% productivity boost. AI tools like ChatGPT, Jasper, they can generate blog posts. So, journalists, financial analysts, copywriters, all have, some risk. The law, legal assistants, paralegals, even attorneys. AI is accelerating document review, contract analysis, due diligence task, all those kind of things. So you probably see lower demand for paralegals and junior attorneys. Just a lot of different things can be impacted. So, in short, don't panic. Learn how to use AI, not compete with it. Upskilling is again your hedge. We know that there's going to be increased election uncertainty still playing out in geopolitics from Eastern Europe to Taiwan. So you can expect markets to stay choppy. Election cycles are usually bullish for stocks, but uncertainty is higher than ever. So keep your expectations grounded. So that is a brief review in terms of recession. I'm still of the view that we have been in one. I'm seeing Like in this last GDP report, business investment expense rose 22%. So far, Trump has received $6 trillion in new investment commitments. Companies are reshoring to the U.S. Companies are going to increase their sourcing of U.S. produced goods. So we're going to have some volatility for the next quarter or two. But I think beyond 6 months, maybe 9 months, we'll start seeing real steady economic growth. So either a recession is coming or going to continue for several months more. My view. I don't think it'll be terribly steep. It seems like most of the big risk we can handle, manage, accommodate. And this view could change based on new data, new information. But as far as what I see now, I think the risk is very modest of anything severe. One last thought to chew on as we are, concerned about overreaction to investment fears. One big issue in all that is if China has met Trump's terms. I'm skeptical. They're in a dire situation. We'll find out more tomorrow about the terms, but I think this is just a step in a multi-phase process. We just don't know enough now, but I just don't think we have reached nirvana with China yet. I just think it's PR for both sides. My impression is Trump and Biden are getting exactly what they want out of China now, so there's no incentive to let up. We'll see. Recessions are normal. Market corrections are normal, but how you respond, that's the difference. Stay flexible, stay informed, don't get paralyzed. Keep moving forward, keep pushing forward. When fear becomes loud, discipline matters more. So the more people get scared, the more fear you hear being projected on the media, at the office, on the internet, that's where your discipline will pay off. So for those of y'all watching, if you made it, this far, thank you. Secondly, you're already ahead of the curve because most people don't prepare. They just react. And hopefully we're giving you some information that helps you better prepare and to have some plans. And one other thing I wanted to throw out, this kind of a simple reminder that you ultimately are responsible for you. You're not going to be able to have somebody else take care of you or blame them for not taking care of you. They won't have the money, the government included. And this is where that really is highlighted. This is a graph showing the unfunded liabilities of the European nations. Unfunded liability is basically a promise made to take care of somebody in the future that they haven't put aside money for. The gold is the amount that has been promised. In the U.S., that would be future Social Security payments, future Medicare, Medicaid expenditures for those people now living. So for the next 75 years, those expenses. The blue is what percentage of that they actually have funded. And nobody has funded 100% of what they promised. That's even a bigger problem when you realize demographics, that there are fewer and fewer young people and more older people. It's like an upside down triangle. And as everybody ages, the numbers get worse because you have fewer and fewer people working to support and pay for those who aren't, those who are retired. So unfunded liabilities. There's a really, really good chance that, the Spanish, the Italians, the Austrians, the French, the Greeks, on down the list, Finland, Portugal, Romania, Germany, So many of them that the people now in their 40s and 50s will struggle to receive what they think they are now due. I mean, you look at this, most countries are 300 to 400% of more in liabilities than money that they have set aside. And if you want to know the US in comparison, the US is roughly 830%. So we would be off the chart. I'm not throwing stones at these countries. I'm throwing stones at every country that has promised more than what they can deliver. I can't change that. And, 20, 30 years from now, I'm not going to be able to force the government to honor their promise. So, knowing that, I have to prepare now for that eventuality. You have to prepare for that eventuality. First, you've got to be aware that that is coming. So, not trying to ruin your day or your Mother's Day, but I just think that's important for people to know. And so many people don't understand that. All right, anybody have any questions? Any comments? If you do, you can email me at moffatonmoney@gmail.com or DM me on X, moffatonmoney. I appreciate the questions. I use some of them on the show. So, any comments you have to improve the show or whatever, we'd welcome those too. Appreciate y'all joining us tonight on behalf of E-Train. We are thankful. We love you guys. Love the members of the family. And we'll look forward to talking to you again Tuesday night, 7:00, which is Q&A. Again, that's a time for you, for your questions. I'll have some, background stuff put together. But if you've got some questions, that's a great opportunity. Appreciate y'all being with us tonight. Hope y'all have a great week ahead. And we'll look forward to seeing you Tuesday night. Our time is up. We thank you for yours. Good night.